We are live. Episode 1 of season 2. I've got a brand new microphone. I got a brand new buddy in Reid Bennett, and I got a brand new show for you guys this year. Super stoked about this. Welcome to a new year and a new season. Look, I host this podcast for one simple reason. I believe that clarity beats noise, and there's no shortage of headlines, opinions, or predictions about commercial real estate. What's missing, I think, is grounded market-specific insight from people actually doing the work, listing, leasing, underwriting, and closing deals in commercial real estate. So this market pulse exists to cut through the national narratives. It's here to explain what's actually happening on the ground in the markets that we're active in, so that we can help owners and investors and operators make better decisions with real data and real context. I say this isn't about hype or hot takes, but those are the two things that get the most impressions on all the platforms. So we will have some hype and some hot takes today and going forward. But more than that, I have been studying what Dan Sullivan calls your unique ability in depth over the last 2 months. My unique ability is about pattern recognition and then mobilizing media, technology, and people around those patterns. This is one of those tools to do that. And so we're here to help you in regards to your pattern recognition, your positioning, and your preparation. Look, we talk a lot about Kansas City. The show is called the Kansas City Commercial Real Estate Market Pulse, sponsored by Midwest CRE Advisors. That's my firm. But look, Kansas City's it's a durable market, but even steady markets shift, right? So our job is to read those shifts early and translate them into action. So if you own, operate, invest, or advise in commercial real estate in the Midwest, this show is for you. And this slide matters, right? Because the Market Pulse isn't just a podcast. This is a strategic tool for our firm. Every episode does 3 things for us. It sharpens our own market understanding. It positions our brokers and our advisors as local experts, not order takers. And it creates consistent high trust touch points with owners and investors. I mean, look, I get calls on a weekly basis. When an owner hears one of our brokers, myself, speak intelligently about pricing, about cap rates, about demand or timing, before they ever meet us, half the work is already done. It also creates alignment. We're operating from the same market narrative, the same data, and the same expectations. So I don't look at this as extra work. It's leverage. The better that we use this platform, I think that commercial real estate brokerage is changing in a way where it's paired alongside media. Look at Bob Knackel. Look at Ryan Serhant. It's happening, right? So the better that we use this platform, the more conversations, the more listings and opportunities it creates for the entire team. And look, this is our team here. Reach out to us if you're looking to buy, sell, or lease commercial real estate in Kansas City. You can visit www.mwcreadvisors.com or simply send me a DM on LinkedIn. My phone number is 573-694-9669. And my email is logan@mwcreadvisors.com. Yes, I'm a Missouri boy, and I say Missouri, MW, because I'm from Jefferson City, Missouri. And I used to bale a bunch of hay when I was 13 and a half years old. And that's how I got all these muscles. Anyways, we got an incredible guest today, Reid Bennett. I've been following Reid for a long time. Reid is the National Council Chair of Multifamily Properties for SVN Chicago Commercial, right? He's got more than 20 years of experience. He specializes in advising owners and investors on the acquisition and the disposition of multifamily properties nationwide, including market rate, workforce, and affordable housing assets such as Section 8 and LIHTC communities, both what we have done here at Midwest CRE Advisors as well. But throughout Reid's career, he's completed hundreds of multifamily transactions and is consistently recognized as a top producing advisor within the great SVN platform. We got so many good buddies at the SVN platform. Took a deep look at starting the SVN here locally here in Kansas City, or expanding upon, collaborating, whatever. So SVN had my number for sure. But he's known for his analytical, data-driven approach. He's a frequent podcast guest and industry speaker. He offers insights on multifamily distress, valuation, capital markets, and emerging investment opportunities across the United States. Reid, we already have a ton of listeners tuning in. So I will tell you, if you would like to ask myself, probably not me, but if you'd like to ask Reid a question today about multifamily, you've got an expert, a nationwide expert here today. So drop your questions into the comments. My team is monitoring. They will call, text me, tell me to look at your comments. Stop talking, Logan, and look at the questions. Katie will be all over me, and we'll get your questions answered. So drop them down in there. Reid, we got a bunch of people in here live. I know you can't see it, but I can see it on my side. Super exciting. Welcome to the show. Happy New Year.
Hey, Happy New Year to you, Logan. I'm pumped to be on with you because it was years ago that I was watching you on LinkedIn, and that's when I kind of got into LinkedIn, and I tried to catch up to you with LinkedIn connections. I just hit 22,000. I was like, sweet.
There we go.
I think I beat him, and I look at you, you're like 35,000. So you're always moving the goalposts on me, man.
Man, we're trying,
Yeah.
I mean, the LinkedIn platform has become harder to grow, I think, because there's more users, right?
Yeah.
Now, that being said, if you got on and you consistently continue to add value, the algorithm is finding that information, and it is elevating that information. But I took an approach about 6-7 years ago and said, am I going to look back 6 to 7 years, 10 years from now and say, man, I wish I didn't post every day on LinkedIn, or wish I did, right?
Great
and I'm trying to find these asymmetrical bets that you can make. Graham Weaver is all up in my head. Never met the guy. Hope I do one day. He runs some private equity company. I forget what it's called, but I love his newsletter. And he was a land warrior. He was a rower over there at, I don't know, I think it's Stanford or something like that. But that's where he was a guest lecturer. And he talks about asymmetrical bets, decisions that you can make every single day that have unlimited upside and very limited, if no, downside. Everybody's looking at for in the investment side, very hard to find.
Yeah.
But in your personal life and some things in your business life, I have found that you can make some of those asymmetrical bets. So for me, it's waking up 7 days a week at 5 a.m. and working out and reading the Bible and then going to take my kids to school. I've got 3 kids, 6, 5, and 2, and then I go to church every single day. And then I do my power list on my Remarkable tablet, and then I get the day started. Those are 5 asymmetrical bets that I make every single day to try and win the day. I had a football coach back in college said, hey, we don't worry about tomorrow, right? We're just trying to win the day. And I got to say, Reid, your LinkedIn comment earlier today pumped me up because you were coming on the show and you got up and you got the workout in, man. So that's awesome.
That's it. Well, I remember you and Jerome Mallory, I think, doing your workouts, and
absolutely,
it was motivating me. And look, if you can motivate one person to do one workout, I think that's a job well done. I mean, have you ever finished a workout in your life and at the end of it said, I wish I didn't work out?
Yeah. Well, I usually would say no to that, but I am training for the World Indoor Rowing Championships right now. And my workouts on Tuesday, Thursdays, and Sundays, sometimes after I'm done, I say, good golly, that was violent.
Yeah.
And I wish I probably didn't go that
far. But you were done with it, though. I had one workout that I wish I didn't do. And it was probably 20 years ago. I was showing my brother how to do dumbbell presses.
Oh, yeah.
And I think I had 80s at the time, and I smoked it out, and I was done, and I was dropping them, and somebody had left a dumbbell standing up underneath, so it crushed the bones in my hand when it landed. That was the only workout I wish I didn't do, but every other one I was happy to do. So pumped to be on.
Absolutely.
Talk about all things multifamily. Actually, my business partner Cody Doran is down showing a 120 unit deal in Kansas City today that we have listed. It's an affordable housing deal that we have on the market. So I love the market. I love the Midwest. We can talk all things Midwest. We can talk across the country. Happy to take it wherever anybody wants to go today. So thanks again, man.
Amazing. Well, we got to just shout out to our live listeners. Benjamin Gutman is saying, is there a Jefferson City, Kansas? No, sir. It is Jefferson City, Missouri. So there you go. And he's watching from the gym right now. Well, he says he's itching. Sorry, he's itching for the gym. Well, get yourself in there, man. Get yourself in there. Look behind me. Look behind me. That's a walking treadmill right there, right? Get some steps in. Do what you can. You could do push-ups. You do some air squats. Maybe you want to do a little Jocko Willink and get some burpees in there, right? And we got Jason Sneed, my man. Jason Sneed says, you've got this, though, Logan. Thank you. I needed that today, Jason. I appreciate that, my man. Let's get into it, guys. We've had some fun. But, guys, we got to talk about this. $162 billion opportunity. Look, Reid, I before this show, I wanted to get in here and I wanted to throw some numbers up here for us to discuss. All right. Everybody keeps talking about the multifamily or just the commercial real estate loan maturity wall. So I wanted to bifurcate that and try to actually figure out what those figures look like.
Sure.
And so what I found was that in 2026, there looks to be around $162 billion in multifamily loans that are maturing. This should say this year. Apologize. This year, which is a 56% increase from 2025. So that might say, right? One might say that owners are facing unprecedented pressure. They have to refinance or they have to sell those deals. And then we also pulled in a nice stat here. Distressed sales have already reached a 10-year high at 5.1% of transactions, right? And so I'm just curious if your figures on what you guys are tracking is somewhat similar to that, or are you seeing something else in the industry right now?
No, I mean, we're definitely seeing that, but you know, we could go back and talk about, you know, the different, what distress actually means in multifamily today, because
let's do that.
You know, I went through the great financial crisis, the GFC, 2008, 9, 10, and this was after, you know, I got into commercial real estate selling multifamily in 2002. So it just started heating up. 2003, 4, 5, 6, 7 was insane with the condo conversions and every, you know,
yep.
I literally thought in 2007 that every single apartment complex and building in the country was going to be converted.
Yep.
And we were going to sell ourselves out of a job. So this is a lot different than that. But the misconception about the multifamily distress is that they're empty buildings, collapsing demand, you know, occupancy rates are dropping. I mean, this is not what is going on. I mean, the reality of what's happening right now, the distress is coming from like, you know, refinance failure or,
right,
you know, capital stress, balance sheet problems. It's definitely not a demand collapse. And, you know, what we're seeing with the distress market right now is basically forced decisions is what we're calling those. So, I mean, it's an issue.
I like that.
It's an issue of financial structures, not the physical asset or quality or occupancy levels, because in the great financial crisis, everybody and anybody that couldn't afford a home or a condo was buying them with what was called no-doc loans. My brother was is a mortgage broker, and he was just ramping up his business during that time, and he was submitting documentation of employment to his boss for the loan applications, and his boss was saying, "What the hell are you including this for? We don't need any of this loan documentation or this employment documentation to give these people loans," which is just absolutely insane if you think about that today, right? Because everything today is very tight. Nobody can get a loan. You know, even to get a supplementary or a HELOC loan, you have to go, you know, jump through like hoops that are ridiculous. So that is keeping people in their apartments, because also the people that had refinanced their homes in 2020, 2021, and 2022 at 3% or sub 3% fixed for 30 years are not leaving their homes. There's no inventory. It's just creating this, you know, it's like a ball and chain for the tenants of apartment buildings to stay in their units. So it's a lot different than what we saw during 2008, 9, and 10.
Yeah, let me double click on that. So what I took away from that is that the structural issues from 2008 to 2010 are very different than maybe the short-term or temporary capital structure distress that we are seeing here, which you guys are calling forced decisions. And I think I have heard this, well said. It's, we've got discretionary sellers, folks who want to sell, and they believe that their business plans have been implemented and it's the right time to sell, versus non-discretionary sellers, which those are forced decisions where they have to make those decisions because the capital that they have financed the project with is coming due or needs to be refinanced. Is that correct?
Correct.
Got it. So very different. And I would completely agree in regards to the supply and demand side of things. I posted today a figure, and it was 2024's net absorption in Kansas City. So net absorption, how many multifamily units were rented and absorbed in Kansas City, right? That were developed. 5,362. Our 2024 completions, 4,144. Average occupancy, 93.2%, and average effective rent up 4.3%. Okay, so that would absolutely back up that statement of this is not a demand side issue, right? This is more along the lines of a capital structure scenario. Now, that $162 billion that I sort of threw out there, right? I mean, for example, Kansas City in 2024, 2025 will typically do somewhere between $8 and $10 billion of commercial real estate, right? Nationally, I think, for 2025, all asset classes were probably somewhere between 450 and $500 billion of commercial real estate transactions. You go back to 2019, 2020, 2021, those were 600, 800, and 900 billion. So that $161 billion, though, that is a sizable amount that needs to be refinanced. So is that pushing you guys to think that, transaction volumes are going to be higher, or do we just see more activity on the refinance side of things?
That's a great question. So the interesting thing about this latest market is, we're coming out of 2022. I think we had, I forget how many Fed interest rate hikes we ended up having, but it ended up being over 500 basis points of increases from the Fed, which I don't think that's ever happened in history in that fast of a time period. So the problem that we're seeing is a lot of the deals that were originated in 2020 through 2022 had significantly below a 5% interest rate.
Absolutely.
We just sold a 100-unit deal up here that had a 2.37% fixed HUD loan until 2055. So the thing that we saw was if you didn't have a HUD loan that had a 35-year fixed rate time, we noticed that there was just a ton of short-term bridge debt that was utilized during that period of time. There was a 5-year debt that was placed on these deals at 3%. So now you're coming into a wall of maturities in 2026 with triple the interest rate levels. Right. So even if you have a beautiful humming, multifamily investment, the problem that we're now seeing is what breaks first is the DCRs, the debt service coverage ratios, right? So those typically a lender wants to see about a 1.25 debt coverage ratio when you're buying a deal. For those of you that are on the call, a 1.0 debt coverage ratio is when your NOI is exactly equal to your debt service, right? So that means you're making zero money. We're seeing a ton of deals come down to 0.9, 0.8. I looked at one the other day that was a 0.66 debt coverage ratio. So that means you're totally losing money.
Yes.
With the deal. You're not going to be able to refinance that deal. And that's when, things are being triggered right now. When that debt coverage ratio drops. So, what happens here is, the sponsors then either have to do capital calls, they have to recap the deal, they have a forced sale, or they have to do a lender workout. Those are the options that they have in that situation. And we've had a ton of owners that have picked up deals in 2021, 2022, they have maybe $15 million of debt on the deal. And they're saying, hey, how can you get us out of this deal? And I'm looking at their numbers, and if the stars align perfectly and everything is humming and we're 100% occupied with 0 vacancies, the property's not worth $10 million.
Mm-hmm. Yeah.
And so what we did for 2023 and 2024 is those were the conversations that we had with a lot of these owners and operators was, here's what you need to do in order to make your property saleable. And we created this thing called the Midwest Multifamily Matrix that helps the owners and operators of multifamily maximize their NOI by showing them where they can sit on the income levels and the rents, and then areas, and we kind of audit their expenses. So where we can kind of see if we can cut their expenses down, because this is the time right now that you need to preserve your NOI to the maximum level, because you have 3 options with the property. Every owner has 3 options, right? There's not a 4th option. 3 options are: you can sell the property, you can refinance the property, or you can hold it and do nothing. But if you hold it and do nothing, you still should be maximizing your NOI and giving yourself the best return, because the owners and operators of multifamily, or any commercial real estate for that matter, they're taking all the risk. They're putting their balls on the line, for the lack of a better term. They should be maximizing the investment there. So
absolutely. Yeah. Okay. So just to walk everybody back through that, the pain that is being experienced is original loan rates in 2019 to 2021 were anywhere between, well, we just heard 2.6. Now I know that not that many people went out and got HUD loans, right? So let's just bifurcate that and say 3.5% to 4%. Today's refinancing rates can be from anywhere from 5.5% all the way up to 8%, depending on what type of deal you've got, right? Yeah. And so increasing DSCR coverage failures is forcing those workout solutions. Got it, right? So like the story that you have been living out on a regular basis is, hey, you've got 3 options, right? And I love to hear more about this Midwest multifamily matrix, right? Because that is so interesting to me. As I was thinking about, I was rereading Hormozy the other day, and he was like, hey, you got to create some differentiated offers, right?
Yep.
Well, after putting this slide together, I started to think, well, what if there is a, advisory that says, look, over 90 days, we can help you understand what your property is worth today, what value you're leaving on the table, and then how to go maximize that NOI. It seems like you've already built that. Tell us more about it.
So it's just an analysis tool that we've been using and perfecting just to help owners figure out exactly how to maximize their NOI based on where their property is sitting, what submarket it's sitting in. We have a number of different tools that we have live management software data that I can drop in their property as it relates to a subset within about a mile radius around them. So we utilize that information to determine where they sit with their competitive subset and what they can do. And then, if there are certain things, like I'm sure you've seen, insurance levels just blow out of the water, right?
Absolutely.
So we're looking at that. So we're trying to say, hey, here's a couple options that you can go to and discuss your insurance premiums. One of the biggest things in multifamily is the payroll. And not only is payroll significant, but trying to find employees in this market has been the biggest pain we've heard from multifamily owners across the Midwest and across the nation, frankly, for that matter.
Yeah, I've heard you speak about that, right? The labor is very difficult to find. Yeah.
Yeah. I mean, we sold a 232 unit deal in Southern Illinois. When we sold it, the manager was making about $65,000 a unit. The new owner was telling me, he said, we can't find anybody, even to come from Champaign, Illinois, where University of Illinois is, to manage this property for $85,000.
Wow.
So and then he's like, I'm even going to offer $100,000 for a management position that was making before, like I said, $50,000, $55,000. And I was like, wow. I mean, it's a 3-hour commute, for me, but I was going to send my wife down there to manage that apartment complex for $100,000. But
man,
that's one of the biggest pain points we're seeing right now in the multifamily space.
Absolutely. Sure. Well, I want to shout out Benjamin. Just wants to make sure he was clear. He knew that Jefferson City was not in Kansas. He says, I was riffing on the Chiefs, man. Pouring salt in an open wound, Benjamin. Look, I dropped an episode last week breaking down that deal. And, the border war is real here in Kansas City. I've got another episode coming. Lockton just left the plaza, headed down to Leawood, Kansas as well. Look, if you're Clark Hunt and you have that business proposal in front of you, that is a very difficult one to say no to, regardless of the history and things like that. I mean, if you look at the details of that deal, it is about the most lopsided, one-sided deal for a sports organization in history. So it would be very tough to say no to that. Now, that being said, I sure hope it works out. I sure hope it comes in on time and on budget. And frankly, I hope that the Kansas taxpayers don't have to bear the burden of that. However, that where it is going is very well suited for what all of the new models of sports stadiums are building. And we're going to get a Super Bowl. So there are some benefits to it as well. I'm going to leave it at that because it is a very opinionated subject. And if you want to debate or talk to me more about that, go on to my LinkedIn. There is a post with 100,000 views now and like 97 comments. We can chat about that right there. Tim, appreciate you showing up. But Tim says, appreciate you and Logan bringing real data and an intelligent perspective on the conversation. Hey, Tim, I appreciate you showing up here. And just on that note, Tim does have a question for you, Reid. This is one of my favorite parts of this show, Reid. I mean, these guys and gals are showing up on their hard-earned time and getting to listen and ask some questions. So he says, how are sellers reacting to the recent Fed rate cuts, and are expectations becoming more realistic right now?
It's a great question, Tim. The interesting thing is every Fed rate cut, there's a completely different reaction from the buyers and the sellers in the marketplace, right? So every Fed rate cut, all of the sellers say, well, interest rates are going to follow. I'm going to either hold off for another month or two to put my property in the market because interest rates are going to drop. It's going to make my property more valuable. Or the offers that are coming in should be significantly higher now that the Fed just dropped the interest rates. The sellers or the buyers are all saying, I just underwrote this deal with my lender and interest rates on the lending side actually went up after this Fed interest rate hike or drop. So it's two totally different bifurcated ways of looking at a deal. And, frankly, a lot of it is baked in well in advance of the Fed reductions. But the last three have really not moved the needle. The last three reductions have not moved the needle. In fact, it's raised a lot of the interest rates from some of our lenders. And I was talking to another lending friend of mine, and he's like, every time these things happen, I'm just getting my door beaten down to refinance a deal. And I tell them the rates went up. They're yelling at me like I'm the devil.
Yeah.
So it's been the strangest debt market that I've ever seen, in 25 years of doing this.
Yes. Yeah. Tim, I would say there's some really good economists that Fed watch, and Edward Yardeni is one that is, I think, an expert in this. He wrote the book called Fed Watching, a pretty dense textbook kind of thing, but you can start to really understand bond yields and the reasoning that they move up and down, or just chat with your friend, Chat GPT, and make sure to double check everything that it hallucinates on. However, it will give you a real quick, synopsis of how this stuff works. But it's definitely something to kind of look into. And, it's interesting the impact of different things that happen in the economic climate that drive those treasuries. I mean, we're talking geopolitical risks. We're talking about tariffs. We're talking about economic uncertainties, GDP levels. But it has made me a better broker, a better investor, and I think a better business person. So might want to pick up some light reading. Edward Yardini, you can check him out. He's always on the Squawk Box and CNBC, so you can check him out there too as well. Well, Reid, I think I might have solved your problem for that owner over there. Jason Sneed said, hey, he'll remotely manage it for $80,000 if they still can't find somebody. So,
well, you bring up a great point, though. Because commercial real estate, multifamily, and every asset class thrives on stability, right?
Absolutely.
Which the last year we've had zero stability.
Very volatile.
And from a political standpoint, I always like it when the last 20 years when I'm not really worried about politics, but just the instability that's in the marketplace right now is it's not helpful for commercial real estate at all.
Right.
But we're also capitalizing on the fact that in the multifamily space, I've always said that, with retail, everybody's shopping online, right? Office, everybody's officing remotely. You can't live virtually yet, where you can sit in a phone booth and feel that you're in a 10,000 square foot mansion. So, that's why I like multifamily, and, the metrics, especially heading into 2026, are looking, pretty robust for multifamily, even with this wall of maturities coming.
Yeah, I do want to, that's a great point. And if you want to sit in a 10,000 square feet mansion in Chicago, Illinois, or right outside of it, just sell a bunch of multifamily properties like Reid Bennett. Look at that mansion he is sitting in. No, I'm just kidding. I know Reid does not live in a mansion. He could live in a mansion if he'd like to, but Reid is a family man and a very good person. Not that if you live in a 10,000 square foot mansion, you're not. Okay. So if you're listening and you do, which I know I have some listeners and some buddies who do that, I'm not dogging on you. All right. But a 10,000 square foot building or house in Chicago is very different than one here in Kansas City. I will tell you that. I got some family out in Crystal Lake, Reid, some brother-in-law and sister-in-law out there. So I do visit them time to time. They just had twins, so they got their hands full. But
well, I grew up in Woodstock, Illinois, right next to Crystal Lake.
Yeah. Okay. Yeah. Well, I love that little lake that they built out there.
Yeah.
It's a pretty cool spot.
Yeah.
Okay. I think this point that Tim brings up here, this buyer-seller disconnect, is exactly what conservative underwriting is so critical today. Is a good one.
Yeah.
And it's a good one because this is the thing that I see on LinkedIn quite a bit. Oh, I started 2 years ago and I had a very clear vision, and it was to buy undervalued multifamily assets with conservative underwriting. And I have done no deals.
Right.
Okay. So how do we respond to that right now? Because I know Tim is hunting for multifamily deals. First and foremost, Tim, make sure you reach out to Reid, get on his list, underwrite the deals that he's going on and working on. But how are you seeing these deals that are being sold? How are the buyers making sense on the acquisition prices? Like, what are they doing? Are they not staying conservative on their underwriting? Are they assuming loans? What is it that's making multifamily deals move right now, Reid?
Well, so we have to unpack that question. There's a lot of different angles for this one, right? So let's start with the assumption of the loans. We sold a number of deals in 2025 that had assumable financing, both HUD and Fannie and Freddie. The challenge with that is the lenders are scrutinizing the buyers that are assuming these loans even more than on a fresh loan. So it's been, to jump through the hoops to do that has been very difficult. The other challenge that we saw with assuming loans is if you didn't juice that initial loan to the maximum that you could, we had a lot, I had a lot of conversation over the last 2 years where the sellers were saying, look, I have this fantastic assumable financing, right? 4% financing, fully assumable. Okay, sweet. Let's take a look at it. What's the loan balance? Well, the loan balance is $8 million and I want 20. The problem there is nobody's coming in with $12 million down for a $20 million deal, even if the loan was 0%.
That's right.
At that point. So that was the big disconnect we saw with sellers that had favorable financing, but not enough juice on the LTV. So that was one of the challenges. I mean,
but Reid, we can just put a supplemental on it and it'll make sense, right?
Yeah. Good luck with the supplemental on these deals. The HUD.
Sorry, that's a little inside joke for some folks that operate in this industry on a regular basis.
Yeah.
So.
Well, that's like saying, I'm selling this deal. The rents are so low, the new buyer can raise them, no problem. The seller didn't want to because he liked all of his tenants.
That's exactly right. Just didn't want to do that.
Just didn't feel like doing it. But and that is one thing also that we're seeing with a lot of the owners and operators is they are raising their rents on the renewals.
Yes.
$100, $150 when they were trying to do that on a full gut renovation of each unit.
Yep.
And that's been the other conversation we've had with a lot of owners where I underwrite their deal. I show them what the value is. And with today's debt structure, what we would likely see from the marketplace. And they're saying, why would I sell that when I'm raising my rents $150? Nobody's moving out. And I've told more people in the last 2 years to not sell at what the market rate will bring them than I have in the last 25 years.
Wow.
Total. Doesn't do a lot for our pocketbooks here. We make money on the transaction, but we're, hopefully, having the discussions with the owners, giving them the real perspective as to what, what we're also doing is we're taking their number, we're putting in either, on the screen in their office or if it's a Zoom, and we're showing them, look, here's where your current T12 NOI is. Here's where we think, even if you make a couple minor adjustments to the income and the expenses, let's bump it up a little bit. Sometimes I'm saying, I'm going to throw you 50,000 more NOI just in case we're missing something. Here's what the value is. And they're looking at that and they're saying, well, one guy said, well, either interest rates have to drop 4% or I have to increase my NOI $200,000 in order to hit the price I want. And I'd say, yes, that's true. And then he said, well, that's highly unlikely to happen anytime in the next 2 years. I said, that's true too.
Yeah.
Why don't you hold it? Let's just maximize this and then we'll eventually sell it later unless you find, the other thing is you have to look at what's going on in the marketplace. If you can find an opportunity that makes sense with today's debt, you should be buying it quickly. Because I've, in the last 25 years, I've seen a ton of owners that bought in high interest rate periods that made millions on a cash out refi when interest rates drop significantly.
Absolutely.
And that's tax free when they do that. So, and you also have to look at what the opportunity is to buy the next deal too. So, okay, so maybe you're not selling at the peak of the market, but maybe you're buying an opportunity that you're buying right now that might not be the peak of the market as far as pricing. So
yeah,
it's all relative. It's all relative.
It is. Well, let's talk about who's actually positioned to win in this cycle. And I think there's a lot of folks here that want to figure out how to acquire multifamily assets. I had a meeting here last Friday in my office. I said, what's your goal? 6 assets in 2026. Okay. Like, how are you going to do that? Right. Like, tell me about your returns and, what types of deals. And, I quickly found out that they had a lot of work to do on what their buy box was. But I think there's probably a lot of people listening in that want to figure out, okay, well, maybe there is one of these distressed deals, but are these distressed deals going back to the lender? Once they go back to the lender, maybe it's a pre-foreclosure. Like, are they engaging with SBN at that point? Or are they going to take it through some auction process? What's the actual logistics of how maybe a buyer can do some things to get in the mix there to say, hey, I have capital ready to go. I've got operational expertise. I've got the market level knowledge, but I'm not seeing that deal flow. What do you tell them, Reid?
Well, first off, there isn't really a lot of distressed deal flow right now.
Yeah, well, there you go.
A lot of people have been waiting for it, expecting a river. There might have been a trickle. There might have been a trickle that has been coming through. In fact, you know, we have an entire team set up around the country that focuses solely on dealing with the lenders and helping them with you know, broker opinion of value for the debt that they have on their books.
Sure.
One of the biggest differences that I've seen over the last year in dealing with a lot of these lenders, Fannie, Freddie, and local banks, has been, you know, in 2008, 9, and 10, the lenders wanted us to give them a BOV so they could put it on their books so they could understand what they're going to charge the note down to. They wanted that physical documentation. We have had a couple lenders that didn't want us to send them anything digitally. They only wanted to get on a non-recorded Zoom and go over our numbers because they didn't want to put that into their folder or have any kind of detail. They wanted to kick the can down the road because lenders do not want to take back buildings.
Yeah.
And, you know, and I've told this story a few times. I remember 2009, there was a deal on the south side of Chicago. It was a small deal, maybe 30 units. And it was we call them California style, right? Where it's like a motel where you walk right into the unit. There's no, right. And so there were, I think it was 24 units or 30 units. Let's just say 24 units. So 24 tenants living in this building. It was taken back by a local lender that was well known. The railing fell off of one of the stairwells and landed in the front yard of the building. When WGN, which is the major network here in Chicago, showed up, all 24 tenants were laying on that stairwell landing in the yard because holding their neck because they knew the lender had taken it back. So the lender does not want to have, you know, they don't want to get into the chain of title. So they're, you know, back in the 8, 9, 10 area, it was all, you know, we were doing short sales where the lender wasn't actually taking, you know, full possession, getting into the chain of title. They don't want to do that. They definitely don't want to do that now. But the difference again is these are 95% occupied, and you know, many of them are paying tenants. So it's a different beast than when it was, you know, 70% occupied with 30% paying tenants because everybody lost their jobs because the economy was so bad.
Right. Yeah.
So, well, and this is a long-winded answer for that question, but you know, the distress, if you're waiting for distress, you're going to be waiting for a long time. You have to be looking for deals. In every market, there are sellers that are selling for some reason. Right.
That's right.
You know, maybe they're sick of dealing with multifamily assets. They're just tired of the daily grind because they are management intensive sections of commercial real estate. Maybe they had a death in the family. Maybe they have a health issue. I mean, there's always sellers in every single market. So you just have to look at that. And, you know, I don't know if you have ever had Bo Beery on. I mean, he created multifamily owners that dominate.
I've read the book.
And, you know, he does a great job as to how you have to be presenting yourself as a buyer, as an owner, and the steps to do with all of the brokers in the market, even, you know, owners in the market. I mean, you have to look at 100 deals. You have to, you know, tour 100 deals, put offers in on 50 of them, get down to 10, and maybe you'll buy one. So it's not like, you know, it's not like the person that's trying to buy those 6 deals in a year is going to look at 20 deals and buy 6 of them.
That's right.
They're going to look at 500 of them.
Yep. And Tim, I won't put your question up on the screen. I think Reid answered it right there, but was really trying to figure out, you know, how do you recommend determining a truly competitive Midwest market when some buyers appear unrealistically aggressive or accepting return profiles that a conservative operator cannot match? I think Reid did a good job answering that question right there. Please do go check out Multifamily Investors Who Dominate. Bo lays out the framework on exactly how to create your deal flow. I think that's really good. Also, I want to second your thought process on having to look at 100 deals. I was just working with a broker, and he said, look, I looked at 500 deals this year. I actually underwrote 167 of those. We made offers on 76 of them, and I closed 9 of those deals, right? So like he had like a 1.8% throughput on that. And his choke point was, how do I get more deals through that pipeline? So I was helping him with with that process, but he knew his numbers, right? I think that's really important to understand, is because you have to know what problem that you're solving for, Tim. So if you're solving for the problem of trying to compete against every other buyer out there, you're going to lose likely, because you're going to find somebody that needs to place $3 million of 1031 capital today. You're going to find, Brookfield or Blackstone, who wants to buy that 150 to 250 unit apartment complex. They've already raised $4 billion to do so, and their cost of capital is extremely low. So find out how many numbers of deals that you have to review, how many you have to underwrite, tour, make offers on to be able to hit your goal, right? But stay conservative, because
and that's why I like the workforce housing. That's why I like, $2 to $20 million deals, because you're not going to be going up against the Blackstones of the world in those. And if you're looking at 1970s, 1980s vintage deals, it's also going to kick out of the box for a lot of the institutional guys as well. But the other thing is, the deals that we closed in 2025, I'm trying to think of one of them that started with the initial buyer we were under contract with. I've never had more deals blow out in due diligence than we did in 2025. Whether they couldn't get their funding, whether they, were anticipating coming in and pulling a retrade rug out from under the seller. All sorts of different things happened where we ended up with the second or third buyer that we ultimately closed the deal. I mean, it was working 3 or 4 times as hard in 2025 to get the exact same amount of deals closed in any other year that I've ever had.
Well, I can second that as well. I just closed the deal with our third, it was the third contract that we had on it, right? Yeah. So right there with you.
So that's another thing. Put your offer in, but don't rely on aggressive growth assumptions or expense reductions to make the deal work. Use the numbers, share the numbers with the broker or the seller. Here's where we are. Help me understand where I'm wrong with my numbers. Share that with the broker and the owner. If they can show you, like maybe you missed something in your underwriting. I doubt it. If if you've been looking at 1,000 deals. But I would say, help me understand where I'm wrong with my underwriting. And, maybe they forgot to share some, cell phone tower income with you or something on the building. But likely they're not. And they're saying, no, your underwriting is right on. And then stay in contact with that broker, stay in contact with that seller, because deals are falling out more so than ever. You might continue to position yourself. And if you're right there saying, look, I'm still here, I still have my debt lined up, I'm ready to go, you just might be awarded that deal.
Yeah, that's a fantastic nugget right there. All right, I'm going to add this back up to our slides. Want to get through 2 more segments with you, Reid. The first one being 2026 outlook and key takeaways. The transaction volume's going up. Are prices going up? Are they going down? What's your outlook? What's SVN's outlook? I read all of the economic outlooks. You guys should check those out. They're fantastic that the team puts out. But what's your personal outlook for 2026?
So, I'm really optimistic about 2026. I mean, I think there's supply shrinkage in especially in the Midwest. Here in the Midwest with multifamily, we don't overbuild like they do in the Sunbelt regions. And that's actually a problem, right? So, I mean, especially here in the Chicago markets, we have, politicians that think that the developers are the enemy, make it very difficult to build. A lot of these areas don't understand economics 101, where if you have more supply, the value goes down. If you have little supply, the value goes up. So, with the shrinking supply, the demand is definitely going up for rents. So the rents will be increasing, which will make the values go up. Although the rents have been stabilizing. I mean, you get to a breaking point, especially in workforce housing, where, if you're above 30% of the tenant's income, that they're really strapped. to pay for that. So there is a, the rents are stabilizing. The interest rates are going to plateau, I hope. And, and then the maturities that we're going to see are going to force some action. So I see there's going to be a lot more deal volume, I think, in 2026 moving forward.
Yep, I would agree. I think it's going to be up 15-16%. So get prepared now. Tim says, hey, he really appreciates that advice, really reinforces the exact approach they've been taking. And I just said, stay the course, Tim. Yeah. Stay the course, my friend. You're doing the right things. My favorite.
I think another quote for 2026 will be, this is going to be the reset, not the collapse.
Yeah.
Right.
I absolutely agree. Yep. Absolutely agree. I'm hoping to get either Akhil Patel or Phil Anderson back on the podcast here in the first quarter for 2026 to continue to talk about the real estate cycle. If you're out there listening and you are an expert in the real estate cycle, the land cycle, you want to come on and discuss that with me, banter back and forth, have a little bit of fun, get out to 36,000 people, get your word out there, reach out to Katie or myself on the team. Love to have you on. I really want to talk to somebody who's been studying that for 25, 30 years because I like to try to remember the future. So my favorite thing to go through with all of the guests, Reid, are the quick takes, my friends. So your favorite book or podcast can be all time or something that you're reading right now. What would be the answer to that?
Well, I get more onto the health because if you don't have your health, you have nothing moving forward. So I'm a big Huberman Labs podcast listener. Andrew Huberman does he gets so cerebral and in depth. I'm listening to that. I'm trying to pay attention to, I'm watching, I'm trying to think of this other one that I was really looking at the other day. Oh man, I'll remember it. But the books that I've been reading, you've announced a lot of them, and you always do a pretty good synopsis of a lot of these groups that stay in the habits. And but the funniest thing is the first book that got me into real estate and understanding it was Rich Dad Poor Dad by Robert Kiyosaki. Way back in the day, made me totally think of different things. I just read Bob Knackel and Rod Santomassimo's book, which was fantastic. If you want to get into the mind of probably one of the best commercial real estate brokers in the country of all time. So those are the things that I'd be looking at right now.
Selling Buildings is a great book. Rod and Bob will be following you up on the podcast in the next 2 weeks. So very excited to have both of them, Bob back on the show and Rod on for the first time. So super stoked about that. All right. Well, we've talked a lot about advice today for someone interested in taking advantage and getting some multifamily, assets. But do you have one main takeaway for somebody that maybe we haven't talked about yet for 2026 for them?
Well, I think, commercial real estate is all about, I call it, wallowing in the mundane. You have to be able to do the same thing over and over and over every day. And if you're trying to find deals, you have to be consistently reaching out when, nothing happens for 2, 3, 4 months at a time. A lot of the panels I've sat on over the last 2-3 years, a lot of the biggest developers and owners and operators have said that they're just sitting back and waiting. Now, sitting back and waiting and being patient doesn't put money in your pocket, but getting into a bad deal will take you down for life. So you have to be patient. You have to be strict with your underwriting on deals that you're trying to buy, and then hang around the rim because there's going to be some rebounds that you're going to be able to pick up.
Love that. Absolutely. Reid, if people want to follow you, reach out to you, get on your deal flow list, start building relationships with you, how do they get in contact and follow you?
Easiest way is LinkedIn. I'm pretty active on LinkedIn. I have all my information sitting on there from my cell phone to my email on LinkedIn. Reach out there. I'll get back to you and we'll get you on the distribution list.
Beautiful. Thank you so much, Reid, for joining us for the first episode, season 2 of the Kansas City Commercial Real Estate Market Pulse. Dropped a lot of knowledge. I learned a lot. We had incredible engagement. So just want to give a shout out to all of our listeners, folks showing up live, bringing us questions, make sure to tune into the next episode, which I'm sure is next week. We'll let everybody know about that. Reid, thank you so much for your time today. If you want to learn more about Kansas City commercial real estate, what's going on, what's happening, here's how you can get in contact with myself. I already gave you my cell phone, my email address, but here it all is. Head on over to www.mwcreadvisors.com. We're here in Kansas City, Missouri. My office is actually in Kansas, but we do work all over the states. So thank you guys for tuning in. Reid, it's been a pleasure, man. Thanks for coming on the show.
Likewise, Logan. Great talking with you, man.
See you guys soon.